Ladies and gentlemen, stop whatever you're doing and listen carefully, because what I am about to tell you is not theory, it is not speculation, and it is not something you will hear on CNBC tonight. This is a live breakdown of a system that is coming apart in real time. I need you to think back for just a moment. Think back to yesterday. Think back to Christmas. Think back to the calm. Think back to how quiet everything felt. The markets were closed. The media was smiling. Analysts were talking about Santa rallies and soft landings. And I came on this camera and told you something that made a lot of people uncomfortable. I told you the calm was fake. I told you liquidity was gone. I told you the market wasn't stable, it was brittle. I told you we were standing in a room filled with gasoline, and all it would take was a single spark to turn everything into an inferno. That spark has now been lit. Look at the screen. Don't blink, don't rationalize it, don't downplay it. Silver didn't rally today. It didn't trend. It didn't grind higher. It teleported. One moment it was sitting quietly. The next moment it was $4 higher in a single shortened holiday session. That is not how healthy markets behave. That is how broken markets behave. That is how markets behave when there is no depth, no liquidity, and no one left on the other side of the trade. This wasn't buyers overwhelming sellers. This was sellers vanishing. And when sellers vanish, price doesn't move in cents. It moves in dollars. This is the part where most people get it wrong. They look at a chart and say, wow, silver had a good day. No, this was not a good day. This was a warning shot. This was the system coughing up blood. In a normal market, a 5% move takes weeks. It takes news. It takes confirmation. It takes debate. What happened today skipped all of that. It went straight to repricing. And repricing only happens when the old price is no longer believable. The market looked at yesterday's price and said, that is a lie. And when markets stop believing their own prices, things get dangerous fast. I want you to understand how fragile today's move actually was. I was watching the order book at the open. I wasn't watching headlines. I wasn't watching Twitter. I was watching the plumbing. And what I saw was terrifying. At 8:30 a.m., a buy order came through. Not a massive one. Not a sovereign fund. Not a central bank. A modest institutional buy. In a normal environment, that order would move the price 10, maybe 15 cents. Today, it hit nothing. There were no offers. No one was willing to sell at $72.50. No one was willing to sell at $73. No one at $73.50. The matching engine had to climb, searching higher and higher until it finally found someone willing to part with their metal near 74. That is what we mean by an air pocket. That is what we mean by a liquidity vacuum. The price didn't rise. It jumped because there was no atmosphere to slow it down. And here is the part that should make your stomach drop. This happened during Ghost Week. This happened when the A-team is not even at their desks. This happened when risk managers are on vacation, when decision makers are off the grid, when the market is being run by junior traders and automated systems with strict risk limits. And even with all that, the system couldn't contain a modest amount of buying. Ask yourself the most important question in finance right now. If this is what happens with the B team, what happens when the A team comes back? The answer to that question is why this isn't over. It hasn't even started. For the last decade, the silver market has been trained like a dog. Every rally was sold. Every breakout was faded. Every spike was crushed with paper. Algorithms were built around one assumption. Silver goes nowhere. Short the strength. Sell the breakout. And that strategy worked until it didn't. Today, we watch that regime snap. We watch the algorithms flip. We watch systems that had been shorting rallies for 10 years suddenly turn green and start chasing price. Not because they believed in silver, not because they read a report, but because their code told them something had changed. A multi-decade high was breached, and with it, the entire logic of mean reversion died. Once you enter blue sky, the rules change. Above the old highs, there are no trapped sellers. There are no bag holders waiting to get their money back. Everyone who owns the asset is in profit. And when everyone is winning, nobody wants to sell. That's not optimism. That's math. That's psychology. That's a seller's strike. And when a seller's strike collides with aggressive buying, price doesn't negotiate. It explodes. But price action alone doesn't explain what we saw today. This wasn't just technical. This was structural. This was global. While New York traders were celebrating $75 silver, something far more important was happening on the other side of the planet. While the Western paper market was waking up, the physical market was already wide awake. Shanghai was open. And Shanghai was screaming something the Western media doesn't want you to hear. The silver price in China is not $75. It's not even close. Converted into US terms, Shanghai just printed the equivalent of $83 an ounce. Let that sink in. 83. That is an $8 premium to New York. In a functioning global market, that gap should not exist. Arbitrage is supposed to erase it instantly. Buy low in New York, sell high in Shanghai, pocket the difference. That's how textbooks say markets work. But textbooks assume something that no longer exists, available metal. The arbitrage is broken because the metal isn't there. Banks can shuffle paper contracts all day long, but they cannot conjure 1,000-ounce bars out of thin air. They cannot load planes with inventory that doesn't exist. They cannot deliver what has already been drained. The gap between New York and Shanghai is not a pricing error. It is a stress fracture in the global financial system. It is the physical market screaming that the paper market is lying. And here is the most important part. The gap didn't close when New York rallied. That's the tell. Silver jumps $4 in the US, and instead of convergence, Shanghai just moves higher too. That means New York is chasing, not leading. The American price is the lagging indicator. The Chinese price is the truth. And the truth right now is that real buyers are willing to pay far more than what you are seeing on your screen because they are not speculating. They are securing survival. This is not Reddit traders. This is not retail mania. This is industrial panic. These are solar manufacturers, battery producers, defense suppliers. These are companies that cannot operate without silver, and when an industrial buyer panics, price becomes irrelevant. If you are building a $50,000 product and silver costs $80 or $100, you pay it. You don't debate it. You don't wait for a pullback. Because without that metal, your assembly line stops, your contracts fail, and your business dies. That is why Shanghai matters more than Wall Street right now. Because Shanghai consumes metal. Wall Street consumes narratives. And if that wasn't enough fuel, the market got its match early this morning. While most people were asleep, a geopolitical line was crossed that the financial media is desperately trying to ignore. A U.S. Coast Guard operation boarded a tanker carrying oil bound for China off the coast of Venezuela. Not sanctioned paperwork, not a warning. A physical boarding, personnel on deck, cargo seized. That is not diplomacy, that is a blockade. You need to understand how markets process that kind of headline. Algorithms don't read nuance, they read threat. They scan for words like seizure, blockade, China, military. And when those words appear together, the switch flips. Risk on becomes risk off, growth becomes protection, currency exposure becomes liability, and assets with no counterparty risk become oxygen. That is why silver didn't wait for confirmation. That is why it didn't grind higher. That is why it leapt. The market didn't have time to argue. It moved straight to survival positioning. If shipping lanes are no longer safe, if sovereign assets can be seized, if the dollar is being weaponized, then paper promises lose credibility fast. And when paper loses credibility, metal becomes king. This is not about Venezuela, it's about precedent. It's about the realization that global trade is no longer neutral, that logistics are no longer guaranteed, that inventory sitting in the wrong jurisdiction is a liability, and silver, unlike bonds or stocks or even gold in some cases, is both money and material. It powers the very systems being used to enforce these blockades. Missiles, satellites, communications, AI hardware, all of it runs on silver. War doesn't destroy demand for silver. War supercharges it. And now, layer this on top of an already empty market. Layer it on top of broken arbitrage. Layer it on top of blue sky technicals. Layer it on top of an institutional sector that owns almost none of it. This is not a rally. This is a regime change. And we are still in Ghost Week. Think about that. The desks that move billions are not even open. The pension committees haven't met. The sovereign funds haven't rebalanced. The mandates haven't shifted yet. What happened today happened in a vacuum. A vacuum that could not absorb even a small shock. That should terrify anyone who is short, complacent, or sitting in cash, waiting for a better entry. Because when the calendar flips, the environment changes. January is when money moves. January is when new strategies are implemented. January is when risk committees panic about being underallocated to what just broke out. And silver is the smallest, most violent, most under-owned asset in the entire commodity complex. If one large pension fund decides it needs a 1% hedge, the market doesn't price it in. It breaks. There isn't enough metal. There isn't enough paper. There isn't enough liquidity to absorb that kind of flow without repricing dramatically higher. That's not opinion. That's arithmetic. And this is where psychology becomes the real battlefield. Because right now, some of you are looking at your screens and thinking about selling, thinking about locking in profits, thinking about being smart. This is the trap. Retail sells breakouts. Institutions buy them. Retail sees a big green number and feels relief. Institutions see the same number and feel fear. Fear of missing out, fear of being fired, fear of being the only fund manager who didn't own the asset that saved portfolios during a crisis. That fear is about to come online. And when it does, the move we saw today will look like a preview, not the event. The moment people hear the word Trump, they assume this is political noise, tweets, sound bites, drama. But what most investors still don't understand is that Trump doesn't speak like a central banker. He speaks like a risk signal. He doesn't explain mechanisms. He telegraphs pressure points. And when he says something is in danger, markets should listen because historically, Trump speaks before policy shifts become visible, not after. When Trump warned that America is losing control over trade, over technology, over manufacturing, over currency leverage, that wasn't a campaign line. That was a reflection of internal briefings. And here's what connects Trump directly to silver, AI, and Wall Street stress. The supply chain war is no longer theoretical. It's active. And AI sits right in the blast zone. Every data center powering artificial intelligence runs on three things: electricity, advanced chips, and metals. Lots of metals. And silver is non-negotiable. It is not a nice to have. It is a core input. Every GPU cluster, every high-speed connector, every thermal interface, every power management system uses silver because nothing conducts electricity more efficiently. You can replace oil. You can reroute gas. You cannot replace silver in advanced electronics without performance collapse. Now pause and think carefully. At the exact moment AI demand is exploding, at the exact moment nations are racing to dominate computing power, at the exact moment militaries are integrating autonomous systems, the silver market is discovering it has no excess supply, no buffer, no slack. This is why the rally is violent, because the future showed up early. Wall Street spent the last 2 years telling you AI was a software story, valuations, narratives, earnings multiples. What they did not tell you is that AI is a material story first. Software scales instantly, hardware does not. And metals absolutely do not. You cannot code more silver. You cannot QE silver. You have to dig it out of the ground, refine it, transport it, and fabricate it. A process that takes years, not quarters. And here's the underreported part. Silver production is not responding to price. Why? Because most silver is not mined for silver. It is a byproduct of copper, zinc, and lead mining. That means even if silver doubles, miners cannot simply flip a switch and produce more. Supply is constrained by other markets entirely. That's why silver bull markets don't climb, they snap. Wall Street knows this, the Fed knows this, and they are deeply uncomfortable with it because silver is the one metal they cannot fully control with paper. Gold can be leased, gold can be swapped, gold can be rehypothecated quietly between central banks. Silver? Silver is too bulky, too industrial, too consumed, too depleted. Once it's used in a solar panel or a missile guidance system, it's gone. Not stored, not vaulted, gone. This is why suppression existed for so long. Silver was kept quiet because volatility exposes fragility. And fragility exposes policy failure. Now let's talk about the Federal Reserve, because this is where things get dangerous. The Fed's nightmare scenario is not inflation headlines. It's not even recession. It's loss of credibility. And nothing shatters credibility faster than a monetary metal breaking free while rates are still restrictive. If silver and gold explode while the Fed claims inflation is contained, the message to the world is clear. The Fed is lying, or worse, powerless. That is why intervention risk is rising. Not overt intervention, not press conferences or emergency meetings. Covert intervention, margin changes, position limits, liquidity injections into specific counterparties. We have seen this movie before. But here's the problem. Intervention works only when there's supply. When the cupboard is bare, intervention accelerates the move. Every attempt to cap price requires metal, and every ounce used to suppress price is an ounce removed from future availability. This is why suppression always ends the same way. Not with control, but with a vertical move that no one can stop. Now layer in pension funds. This is the quiet giant nobody wants to talk about. For years, pensions avoided commodities. Too volatile, too small, too messy. But something has changed. Bond math no longer works. When liabilities stretch decades into the future and real yields are unstable, pensions need real assets. Not paper promises, not duration games, real assets. Even a tiny shift matters. A 0.5% allocation, 1%. That's all it takes. There are trillions sitting in pensions. Trillions. And silver's entire annual investment supply is measured in the low billions. Do that math slowly. Do it twice. Then understand why today's move was not the event. It was the alarm bell. If even one major pension committee decides silver is a strategic hedge against currency instability and AI infrastructure risk, price doesn't negotiate. It gaps. It reprices to a level that forces demand destruction. And demand destruction in silver doesn't mean fewer investors. It means fewer products, fewer panels, fewer systems. This is why governments are nervous. Because silver is where financial stability collides with physical reality. And now, the dollar. Every rally in silver is a referendum on the dollar's credibility. That's why foreign demand matters so much. Shanghai isn't buying silver to speculate on US CPI. It's buying silver to hedge against a world where dollar settlement is weaponized. When tankers are boarded, when assets are frozen, when payment systems become tools of policy, trust evaporates. And without trust, reserve currency status erodes slowly, then suddenly. Silver rising alongside gold is not a commodity story, it's a confidence story. And confidence, once lost, is never regained quietly. Now ask yourself, why now? Why did this happen during a holiday week? Why did it happen before official announcements? Why did it happen when most people weren't watching? Because markets move when positioning is wrong. For months, traders were short volatility, short metals, long tech, long calm, long narratives. AI stocks were crowded, silver was abandoned. That imbalance created pressure. All it needed was a trigger, and the trigger wasn't one headline. It was accumulation of stress, trade fractures, energy seizures, AI material demand, physical shortages, broken arbitrage, pension math, Fed credibility, dollar risk. At some point, the system stops absorbing stress and starts releasing it. That point was today. The most dangerous mistake right now is thinking this move needs to cool off. Cooling off requires sellers. Who is selling? Miners can't, industrial users won't, sovereigns won't. Long-term holders see validation, not excess. The only sellers left are paper traders, and they are already underwater. Which brings us to the next phase, forced behavior. When price rises fast enough, behavior changes. Shorts cover, options, dealers hedge, algorithms flip trend, momentum funds chase. This creates a feedback loop, not because everyone agrees, but because no one can afford to be wrong alone. This is how silver goes from ignored to unignorable. And when that happens, the media narrative flips overnight. Suddenly, silver isn't volatile, it's strategic, it's critical, it's essential for AI and national security. The same outlets that mocked it at $25 will chase it at $90. That's how this always works. We are not there yet. This is still the early phase, the disbelief phase, but disbelief does not last long when price keeps talking. And remember, this is still before January flows, before new mandates, before panic hedging, before emergency meetings, before official recognition, which means the most violent part of this story has not been written yet. The reason Wall Street fears silver more than almost any other asset is not because of its size, it's because of what silver exposes. Stocks can crash and be blamed on sentiment. Bonds can fall and be blamed on policy. Crypto can implode and be blamed on speculation. But when silver rises aggressively, there is nowhere to hide. Silver doesn't rally because of hype. It rallies because something underneath the system is failing. This is where psychology breaks. Every market has a pain point, a price level where denial turns into panic. For silver, that level isn't 75. It isn't even 80. The real psychological fracture happens when price sustains above the old narrative ceiling and refuses to come back down. That's when portfolio managers stop asking, should we buy? And start asking, why don't we own this? And that question is deadly. Because once it's asked inside an institution, it spreads. Risk teams start running scenarios. Compliance asks uncomfortable questions. Consultants flag underexposure. And suddenly, silver isn't a trade. It's a liability if you don't have it. This is how capital moves in waves. First comes disbelief, then comes intellectual justification, then comes forced allocation. We are between disbelief and justification right now. Wall Street analysts are scrambling to retrofit explanations. You'll hear phrases like supply chain constraints, green energy demand, AI-driven materials cycle. These aren't insights, they're excuses. The truth is simpler and more dangerous. The price was wrong, and the market finally noticed. Now, let's talk about the number everyone is afraid to say out loud, $100. Most people hear that and laugh. They compare it to history. They adjust for inflation. They say it's unrealistic. That reaction is exactly why it happens. Markets don't move to where people are comfortable. They move to where positioning breaks. At $100 silver, several things occur simultaneously. Industrial demand begins to strain visibly. Hedging activity explodes. Mining equities detach from fundamentals and trade on scarcity. Options markets lose control. And most importantly, silver stops being seen as cheap gold and starts being treated as its own strategic asset. That's when the Fed's problem becomes unavoidable. Because the Fed cannot explain $100 silver without admitting one of three things. Inflation is not under control, currency confidence is eroding, or supply chains are structurally broken. Any one of those undermines policy credibility. All three at once would shatter it. This is why narrative control matters so much right now. The Fed will try to frame this as a commodity spike, a temporary imbalance, a reaction to geopolitical noise. But the longer price stays elevated, the harder that story becomes to maintain. Markets are patient, optics are not. And here's where Trump's warning loops back into the story. Trump understands one thing most politicians don't. Perception drives behavior faster than data. When he talks about America losing leverage, about trade becoming hostile, about technology becoming weaponized, he is articulating what markets are already sensing but haven't fully priced in. A world where AI, energy, and metals are strategic choke points is a world where old financial assumptions fail. In that world, silver is not an investment, it's insurance. And insurance is always underpriced until the fire starts. Now consider volatility. Silver is not like gold. Gold moves politely. Silver moves violently. That's because it's small, thin, and emotionally charged. When capital enters, it doesn't seep in. It floods. And when fear enters, it doesn't fade. It detonates. That volatility is not a flaw. It's a signal. High volatility means the market cannot agree on value. And when a market cannot agree on value, price discovery becomes explosive. That's exactly what we are watching unfold. This is why pullbacks will feel terrifying but shallow. This is why rallies will feel irrational but persistent. This is why people will keep waiting for confirmation that never comes. By the time confirmation arrives, price will already be somewhere else. And now we arrive at the most uncomfortable truth of all. This move is not about making money. It's about preserving relevance for funds, for institutions, for currencies, for systems. Silver is rising because the old architecture cannot support the new reality. AI needs metal. Energy transition needs metal. Military modernization needs metal. And financial repression has starved that metal of investment for decades. You cannot underinvest in a critical input forever without consequences. Those consequences are now being priced, and the market does not care who is ready. It only cares who survives. We are still early, but we are no longer early enough to ignore it. What comes next will not be calm, it will not be orderly, and it will not wait for consensus. Because once markets shift from pricing growth to pricing security, everything changes, and silver is where that shift becomes visible first. The moment Wall Street capitulates is never announced. There is no bell, no headline that says capitulation achieved. It happens quietly, behind closed doors, in risk meetings that were supposed to be routine and suddenly aren't. It happens when a senior portfolio manager asks a junior analyst a question that sounds harmless but isn't. Why didn't we see this coming? And when that question hangs in the room without a good answer, the shift has already begun. Capitulation doesn't start with buying, it starts with blame. First, funds blame the Fed. Then they blame geopolitics. Then they blame data. And finally, when none of that fixes the P&L, they blame positioning. That's when the real damage is done. Because once positioning is blamed, it must be corrected. Immediately. This is where silver becomes uncontrollable. Up to this point, silver's rise can be explained away. Analysts can point to China, to AI demand, to temporary supply issues, but there's a specific moment when those explanations stop working. When silver keeps rising, even on good news. When inflation prints cool and silver doesn't fall. When rates hold steady and silver doesn't retreat. When stocks rally and silver still refuses to give anything back. That's when Wall Street realizes this isn't a hedge anymore. It's a signal that something deeper is wrong. At that moment, media narratives flip, not gradually, but violently. The same anchors who dismissed metals as dead money suddenly start using words like strategic, essential, critical infrastructure. Panels appear. Charts get redrawn. History gets rewritten. Silver is no longer volatile. It's misunderstood. No longer fringe. It's foundational. This narrative flip is not journalism. It's survival, because media doesn't lead markets. It protects credibility. And when a move becomes undeniable, the story must change to make it look inevitable. That way, no one has to admit they were wrong. They just say the situation evolved. But behind the scenes, something far more dangerous is happening. Derivatives begin to break. The silver's paper market is many times larger than its physical market. For years, that didn't matter because most contracts were never meant to deliver. They were meant to settle quietly, rolled forward, cash settled, forgotten. But when price rises fast enough, confidence in that process evaporates. Suddenly, more players stand for delivery, not because they need the metal, but because they don't trust the system anymore. This is where stress becomes visible. Delivery times lengthen, premiums rise. Eligible inventory stays put while registered inventory drains. Spreads widen. And then, quietly, force majeure clauses start appearing in the fine print. This is the stage where authorities get involved. Not publicly, not officially, but urgently. Banks call regulators. Regulators call exchanges. Exchanges adjust rules. Margins go up. Not to reduce risk, but to shake out participants. Volatility is blamed. Speculation is blamed. Anyone but the structure. But here's the problem. Raising margins in a thin market doesn't cool price. It accelerates it. Weak hands are forced out. Strong hands remain. Liquidity thins further, and every dollar of new buying moves price more than the last. This is how control is lost. And once control is lost, the end game begins. The end game is not a crash. It's a repricing. A repricing of what money means, what assets are trusted, and what systems can be relied upon in a world where supply chains fracture and politics overrides economics. Silver sits at the center of that repricing because it is both a mirror and a weapon. A mirror reflecting policy failure, a weapon exposing fragility. That's why it scares institutions more than Bitcoin, more than meme stocks, more than volatility indexes. Those can be dismissed. Silver cannot. Now, step back and look at the broader picture. Wall Street is not breaking because silver is rising. Silver is rising because Wall Street is breaking, because debt levels no longer make sense, because growth is financial, not physical, because AI promised abundance but revealed dependency, because globalization optimized cost, not resilience, and because trust, the invisible glue of markets, has been quietly dissolving. This is why the ending of this move will not be euphoric. There will be no celebration. When silver finally reaches the level where demand is destroyed, where substitution becomes mandatory, where governments intervene openly, the mood will not be triumph. It will be shock. Shock that it happened so fast. Shock that warnings were there. Shock that calm lasted as long as it did. And by then, the question will no longer be, is silver too high? The question will be, what else is mispriced? Because once one lie is exposed, every other price is suspect. That is the real danger, not silver at $100. But what silver at $100 implies about everything else. After repricing, the system does not return to normal. It never has. It reconfigures. And reconfiguration is not neutral. It produces winners by design and sacrifices by necessity. This is the phase where policy stops pretending and starts choosing. When silver forces its way into the center of the financial narrative, authorities face a constrained set of options. They can allow price to continue rising and accept what the signals about currency credibility, or they can intervene openly and admit that markets are no longer free. There is no third path. Soft landings are stories told before impact, not after. Historically, the choice is always intervention. But intervention does not mean reversal. It means rationing. First comes access control. Large players are prioritized. Strategic buyers are protected. Industrial users with political importance get supply assurances. Everyone else pays premiums or gets nothing. Price becomes secondary. Allocation becomes the real market. This is how financial assets turn into strategic assets. At that point, silver is no longer discussed in returns. It is discussed in availability. This is where most investors misunderstand the cycle. They think the end is a blow-off top followed by a crash. That assumption is based on speculative bubbles. Silver is not behaving like a bubble. It is behaving like a constraint. Constraints do not pop. They bind. When demand collides with non-expandable supply, the system adjusts by excluding participants. Not everyone gets access. Not everyone gets protection. That is the reset. Who gets protected is not determined by markets. It is determined by power. Governments protect defense supply chains. Energy infrastructure, critical technology, AI, communications, medical systems, anything framed as national security. That framing expands quickly when pressure rises. Who gets sacrificed is equally predictable. Retail investors, small manufacturers, late hedgers, anyone without leverage, scale, or political relevance, they are priced out quietly. No announcement, no apology. This is why the post-repricing phase feels unfair. Because it is. Markets stop allocating capital efficiently and start allocating scarcity politically. That is the part nobody wants to say out loud. And this is why this cycle does not reset the way previous ones did. In prior commodity spikes, new supply eventually arrived. New mines, new technology, new regions. Time solved the problem. That assumption fails here. Silver supply is structurally rigid. Environmental constraints, declining ore grades, byproduct dependence, and capital starvation have removed elasticity from the system. Even high prices do not fix that quickly. Which means the cool-off phase is not a return to cheap silver. It is a plateau at a much higher level, punctuated by volatility, controls, and episodic shortages. This is not a trader's environment. It is a strategic environment. And this is where the broader implication becomes unavoidable. If silver had been mispriced this badly for this long, under the watch of the most sophisticated financial system in history, then the problem is not silver. The problem is price discovery itself. It means signals were suppressed, incentives were distorted, capital was misallocated, and risk was hidden, not removed. That realization does not stay contained. Once investors accept that one critical input was systematically underpriced, they begin questioning everything else. Bonds, currencies, equity valuations, growth assumptions, pension math, government promises. Confidence does not collapse all at once. It erodes through specific failures. Silver is one of those failures. That is why this moment matters beyond the metal. Because markets can survive losses. They cannot survive disbelief. And disbelief spreads. Not through panic headlines, but through quiet reallocation. Through hedges that become core positions. Through temporary measures that never reverse. Through a gradual withdrawal from trust-based systems into asset-based ones. This is the shift that defines decades. Not a crash, a reorientation. And once it begins, it does not need constant drama to continue. It runs on incentives. That is where this ends. Not with celebration, not with collapse, But with a colder, harder financial reality where protection costs more, access is limited, and assumptions are no longer free. That is the consequence phase, and by the time it is obvious, positioning will no longer matter, only preparation will. Subscribe for market insights.